Whole life insurance is the original guaranteed life insurance product. It has a guaranteed premium, a guaranteed death benefit, and a guaranteed accumulation of cash value. And for those who are seeking a life insurance policy that will ensure that life insurance coverage exists for their entire lifetime, provided that they make good on their obligation to pay the premium, whole life insurance is the product they flock to. That being said, there are some whole life policies in existence today that are failing their policyholders. And by failing, I mean they're forcing the policyholder to do things that they never thought they were going to need to do. So what's going on? What's driving this? And what do you need to do if you happen to own a whole life policy that may be on this same course? I want to be clear about something right from the outset. What we're going to talk about today is whole life insurance policies that are being impacted by non-guaranteed features where policyholders are having a difficult time differentiating between guaranteed aspects and non-guaranteed aspects of their whole life policy. If you happen to own a regular whole life policy with a set premium, and all of that premium is whole life insurance, and you have no intentions of making any changes to that policy, then none of what I'm about to discuss applies to you. If, on the other hand, you own a whole life insurance policy where you are using a non-guaranteed feature to do something to that policy that was not originally part of the guaranteed contract, you should pay attention, because you may need to change course with your policy now or at some point in the future. I also want to note that using non-guaranteed features of a whole life insurance policy does not necessarily mean there's a problem. But if you are using non-guaranteed features, you do want to occasionally check up on your policy and make sure things are going as intended. So there are two primary areas of concern when it comes to the whole life insurance policies we're discussing today. One of them has to do with the way premiums get paid, or perhaps not paid by the policyholder, but rather by some other aspect of the contract. The other aspect are people who bought whole life insurance several years ago with a premium in design that was intended to make whole life insurance look cheaper than it really was. Let's start by tackling the premium aspect. When you buy a whole life insurance policy, traditionally, not only do you choose the death benefit amount that you would like, but you also choose a guaranteed payment period. Now, for most people, they may not be aware of this guaranteed payment period because the agent defaults it to the insured's age 100 and they just know that they have to pay premiums basically for their entire life. But being paid up at age 100 is not the only type of whole life insurance that exists. You can have whole life policies that are paid up later, let's say age 120, and a whole host of whole life policies that can be paid up much sooner than that, say age 65, or after 10 payments, or after 15 payments, or after 20 payments. When it comes to whole life insurance, there absolutely is going to be a critical decision made about the premium payment period. Now, if you buy a whole life policy, and you pay all of the premiums that are scheduled under this guaranteed premium payment period, you will have reached paid-up status with the policy. This means that no future premiums are due, your death benefit does remain in force, your cash value will continue to grow, and if you have a dividend-paying whole life policy, you'll continue to earn dividends. Critical to this point is the fact that you cannot lose your policy because you do not make future premium payments. They're no longer required. Some people, however, use non-guaranteed features of their whole life policy to pay their premium when it's due, instead of having to pay a premium themselves out of pocket. The most common situation involving non-guaranteed elements paying the premiums of somebody's whole life policy is the dividend option to pay premium. This works when the dividend payable on a whole life policy is large enough to cover the entire premium due on the policy. So for example, let's say that you own a $500,000 whole life policy. It has a $15,000 premium, and you've paid it for the last 25 years. This year, your dividend payable on the whole life policy will be $18,000. That dividend is large enough to cover the entire premium payment. You could choose at this point to change your dividend option to pay the premium, and you don't have to anymore. In theory, moving forward, provided the dividend rate doesn't go down, the whole life policy is capable of paying this premium for you with the dividend earned on it for the rest of your life. In fact, there were a lot of whole life policies sold with this very idea in mind. Instead of buying something like a 10-pay or a 15-pay, people bought whole life policies that were paid up at age 100 with the intention of using the dividends they would earn on that policy to cover the premiums as soon as the dividends were large enough to do that. For a number of these policies, that point came relatively early on. Let's say by year 10 that the policy was in force. At that point, the policyholder began using dividends earned to pay premiums and has done so ever since. The one downside that has developed, though, is that interest rates from the entire US economy have dropped quite considerably over the past several decades. And with those interest rate declines, dividend rates on whole life policies have also followed suit. This results in fewer dividends being paid to policyholders than were originally assumed. And in some situations, dividends have reduced to a degree where they no longer cover the premium that's due on the whole life policy. In these situations, policyholders are now receiving premium due notices because the dividends that they earn are no longer large enough to pay their entire premium. Now, since most people don't speak insurance fluently, for obvious reasons, they don't know what to do with these notices and they kind of don't believe them. They ignore them. The premium goes unpaid and now additional problems come up. Or, for some people who do take heed of this notice, they realize they must pay a premium in order to keep their policy in force, and this causes a problem since they were under the impression that they no longer had to pay premiums to their whole life policy to keep their death benefit in force. If you own a whole life policy where you're using your dividends to pay your premium, you may be in no trouble at all. But it's well worth looking into to ensure that your current and future projected dividends are adequate to cover the premiums that will come due on your policy today and long into the future. If you don't do this, you may discover at some point that your dividends no longer cover your premiums due and you'll need to pay them, or else you might lose your coverage. Now, not every situation where somebody is paying for their premiums through a non-guaranteed feature of their whole life policy is necessarily a function of dividends being used to do this. You can also take the cash value of your whole life policy, or more specifically, the non-guaranteed cash value of your whole life policy, and you can use it to pay premiums due on your policy. We commonly refer to this as an offset inside the industry. And I assure you, it's a very common and legitimate way to pay premiums, especially when dividends aren't large enough to cover them. But when you do this, you have to ensure that your policy's cash value accumulation will outpace the drawdown you'll be using to pay premium. If it's not, eventually you'll run out of money and you'll either have to make premium payments or lose your policy. Again, if you're using an offset to pay premiums due on your policy, everything may be a-okay and you have nothing to worry about. But it's well worth looking into to ensure that you're on a trajectory that suggests everything's going to be okay. It may also even be prudent to look at an in-force ledger on your policy under a reduced dividend versus what's going on today to ensure that if dividend changes come, and those changes are a negative adjustment to the dividend, that you will, in fact, continue to be able to do what you're doing without any need to maybe one day continue making premium payments. We have personally been involved in several situations where people have come to us to review policies where dividends were being used to pay premiums or offsets were in place, and sadly, changes had occurred, and at some point in the future, the policyholder was no longer going to be able to use their dividends or an offset to continuously cover the entire premium that was due. Sadly, in these situations, we have to tell policyholders that either they must be prepared to continue making premiums at that point, be even better if they started doing it now, or they're going to have to make some serious changes, buy a new policy, or make significant changes to their current policy. We can't undo the reality that this may be necessary for somebody either now or in the future, but we can certainly do our best to minimize the negative impact of this thing happening. Okay, let's talk about the other non-guaranteed element that is causing some whole life policies to fail their policyholders' expectations. Years ago, we're talking 3 decades or so ago, whole life insurance picked up its first major competitor in the permanent life insurance arena as universal life insurance was starting to hit the scene, and it was offering a lot of fancy features that whole life insurance had never made available to people. Chief among them was a very flexible premium that allowed individuals to assume that perhaps accumulation of values would be really good or better than expected, and that would enable them to actually pay less premium to their policy for the same level of death benefit. This led to a number of agents comparing whole life insurance premiums to universal life insurance projected premiums and suggesting to people that they could get the same amount of coverage for something less in terms of premium, maybe quite a lot less, like close to half of what the whole life insurance policy was going to cost. Not surprisingly, a lot of people started buying universal life insurance because they were convinced that it was the cheaper alternative. This has led to a problem all on its own, but that's a discussion for another day. What whole life companies started to do was create fancier features to their products that use non-guaranteed elements to make the premium payable on a whole life policy cheaper. This involved a process called blending. And blending is simply a function of taking whole life insurance and a term life insurance rider, putting them together and selling them as one policy. And I do want to focus on the one policy aspect here. We're not talking about buying a little bit of whole life insurance and some term insurance to supplement death benefit. We're talking about wrapping them up together and buying them as one packaged deal. You can't have one without the other in this situation. Now, you will hear policy blending or whole life blending talked about in other circles or even at the Insurance Pro blog in very favorable terms. And most notably, it works very well when people are trying to specifically manipulate whole life policy for its cash accumulation features. That has nothing to do with what we're talking about here. We're simply talking about using blending as a means to make whole life insurance premiums appear cheaper. What we're doing is we're taking some whole life insurance and then some term insurance and putting them together. Because we have less whole life insurance, the premium could be less than if we were to just buy a regular whole life policy. But when we do this, we're very dependent on the dividend that's payable in the future on this whole life policy. Because that dividend is going to ultimately replace the term insurance death benefit with death benefit created from paid-up additions. Paid-up additions are simply an extra funding mechanism that people have available to them with whole life insurance where they can put more money into it. And it's often where dividends go when people buy whole life policies. The payment of dividends and the use of those dividends to go towards paid-up additions reduces the term insurance that exists on the whole life policy, with the eventual plan that all the term insurance will go away and everything will be whole life insurance with whole life insurance paid-up addition death benefit. If this scenario unfolds as planned, everything's great, and the individual got away with a much lower outlay to buy permanent death benefit. Sadly, not everything went great, because 3 decades ago, we had substantially higher dividend rates than we do today. So what people thought they were going to have to pay to accomplish this removal or replacement of term insurance through paid-up additions ended up being some number much larger. In fact, basically what whole life policies would have projected if they had just bought regular whole life policies. This leaves a number of people in an unfortunate situation where they discover many years down the road that the premium they've been paying is inadequate. And in order to keep the death benefit that they have in force, they're going to have to contribute significantly larger contributions in premium to their whole life insurance policy. The only other option to them is to accept a reduced death benefit by shedding the term insurance that's on their policy. This, of course, can be a very undesirable scenario for a number of people who needed and intended to have this death benefit for their entire life. Now, again, you may have one of these blended policies and everything could be fine, but your best bet is to check on things and make sure that the premium you're paying is adequate to sustain the death benefit that you have for your entire life. So, how do you go about checking on your policy that's in force to find out if your dividends are going to continue to pay your premiums, if your offset is going to continue to work out, if your blended policy is going to be able to maintain the death benefit it has for the premiums that you're paying. The best thing you can do is call your insurance company and request that they send you an as-is in-force illustration. That will give you a detailed accounting of your policy values and what they're projected to be well into the future, in fact, for the rest of the contract's assumed existence. Now, I do understand that as a layperson, you may look at that document and become very intimidated and confused by it. If you're still working with the agent who sold you the original policy, you should sit down with that person with the in-force illustration and go over those figures. If you've lost contact with your original agent, it would behoove you to establish a new relationship with a new agent who can look at that document and interpret it for you. It would also be beneficial to get one of these in-force illustrations and assume that the dividend goes down to see how values unfold from there. Can your dividends continue to pay your premiums? Will your offset continue to work? Are the premiums that you're paying for your current death benefit on a blended design adequate to keep the death benefit that you have in force? Some of these in-force illustrations will already make that assumption by default, but some will not. So you should inquire with the insurance company when you call to request it if it'll automatically be included or if you'll need to request an additional in-force illustration that assumes this scenario. To reiterate, I want to be clear that just because you're using a non-guaranteed feature of your whole life policy, you may not be in any trouble at all. It's just well worth double checking to make sure that everything is unfolding the way that it was intended. Also, you shouldn't shy away from using non-guaranteed features of whole life policies to enhance what you can get out of them. It may make perfect sense to buy a 10-pay whole life policy if you only want to make 10 payments and then be paid up. It may, however, make sense to buy a non-10-pay whole life policy and use guaranteed feature to effectively make it a 10-pay policy. This could result in you having to commit fewer dollars to your insurance contract, which allows you to do something else with the money that you saved. Using non-guaranteed features of a whole life insurance contract to accomplish things that you would otherwise need to guarantee with other whole life policies is something skilled insurance agents show their potential policyholders all the time. And it would behoove you to seek out the expert advice of a well-skilled agent in this regard if you want to look into this possibility. Also, you should know that the majority of whole life policies in force have no issues and there's no reason to worry. But if you happen to be one of the people who owns a policy that is currently using one of these non-guaranteed features and it may be headed down the road of problematic, you definitely want to know. You want to know much sooner than later. And of course, we do have additional resources at theinsuranceproblog.com that you can get for free to look at and try to discern some of what's going on with your whole life policy. Thanks for watching, everyone.